Okay, so namaste and welcome back to our series on international taxation under the New Income Tax Act and the new income tax rules. So, guys, I hope all of you are doing great. So, in the earlier videos, we understood the basic framework of residence, scope of total income, non-resident regime, double taxation relief, transfer pricing, APAs, and many other concepts. And guys, as you all know that we are covering the all the concepts of international taxation in a series of 10 concepts in each and every videos. So till now I have already uploaded 3 videos covering 30 concepts. So now I am resuming this series with concept number 31. So guys, concept number 31 is the concessional regime basically. Just a minute, let me use this laser pointer here. Okay, so this concept number 31 is the concessional tax regime for royalty and fees for technical services. We call it FTS basically. So it is earned by non-residents and foreign companies, right? So guys, section 190 of the Income Tax Act 2025 provides that special rate structure for certain incomes of non-residents, including royalty and FTS, if received from the government or an Indian concern under an agreement approved by the government, basically. So, where these conditions are satisfied, the royalty or the FTS is taxed at a flat 20% rate, and the remaining income, if any, that will be taxed at normal applicable rates. So, guys, importantly, no expenditure deduction is allowed against these specified income from royalty and FTS streams, right? The 20% rate applies on the gross amount. Further, if we proceed here, so where the total income of the non-resident consists only of such section 190 income, and the tax has been correctly deducted at source at the prescribed rates. So guys, the non-resident is not required to file a return of income in India for that particular tax year. For example, if we see here, a foreign company that only earns, royalty or FTS income from the Indian company under the government approved technology agreement, basically. So with a TDS at 20% on the gross amount. So it may fall within the this, return filing relaxation if there is no other Indian source income. So this is the concept of royalty and FTS in a summarized manner. Let's move to concept number 31. Concept number 32 here basically. So guys, section 208 here applies to an overseas financial organization, right, that invests in India in units of specified schemes or mutual funds using foreign currency. Here the word foreign currency is very important, and the investment should be through an a- I mean arrangement approved by the SEBI or the Indian bank or the financial institution, basically. So guys, in such key cases, here income from the units is taxed at 10%, and the long-term capital gains on transfer of those units are taxed at 12.5%. While other income is taxed at a normal rate. So guys, three tax rates are there: 10%, 12%, and the normal tax rates. Again, like ordinary business expenditure and certain chapter 8 deductions are not allowed against these specified unit incomes. So, and the concessional rates apply on gross income as defined in the section. So guys, here if a if an offshore fund registered in country X, say, invest foreign currency through a notified scheme, into units of an approved Indian mutual fund, so its dividend income from those units would suffer 10% taxation, and the LTCG or the long-term capital gain is covered under 12.5% in India, without further business deductions, provided all conditions of section 208 are satisfied. So guys, this is the concept of overseas financial organizations, or we call it OFOs. And if we move to concept number 33, which talks about the bonds and the GDRs, right? So, guys, concept 33 is basically focuses on income of non-residents from certain bonds and the GDRs governed by section 209 here. So, guys, section 209 covers non-residents who kind of invest in foreign currency in specified bonds issued by the Indian companies or the public sector companies, and the GDRs of Indian companies issued in accordance with the notified schemes. So, interest on these bonds and dividends on such GDRs, right? So these are taxed at a concessional rate of 10%. And again, the long-term capital gain on transfer of those bonds or the GDRs are taxed at 12.5%. So guys, there are also a special competition rules. For example, in taxation benefits are denied for these capital gains. This is the most important point to remember here. And again, certain deductions are restricted to kind of preserve the concessional character of the regime. And here, crucially, where the non-residents total income consists only of such section 209 interest or the dividend, and the tax due has been deducted at the prescribed rates. So the non-residents is not required to file a return of income for that particular year in India. And if we see a small example here, a non-resident who only receives interest on notified rupee bonds, of an Indian public sector company, and the dividends on qualifying GDRs with 10% TDS deduction here, can typically rely you know, on this filing exemption. So this is a concept about the GDRs and the bonds. Let's move further to concept number 34 here. So guys, concept 34 deals with the special rate structure for foreign institutional investors, or we call them FIIs, and specified funds on their income from securities covering by section 210. So section 210 provides that income of FIIs and specified funds from securities is taxed at a fixed rates, you know different from the normal business taxation rates. So guys, broadly, income in respect of securities other than certain units is taxed broadly at 20% for FIIs, and 10% for specified units, while kind of short-term capital gains or long-term capital gains on different categories of securities are taxed at very, at, or I would say the, concessional rates depending on the nature of the asset, and obviously the holding period. For specified units or specified funds, I would say the concessional regime is restricted to the portion of the income attributable to units held by the non-residents without the P in India. The act and the rules, lay down attribution rules here for splitting the fund's income between eligible non-resident investors and others. So this is mentioned here in the attribution rules here. And if we see the small example here, so guys, we have to see that an FIIs with interest and capital gains on Indian listed securities will compute tax on those streams at a prescribed section 210 rates, instead of normal corporation tax rates, and cannot reduce that base with the business overheads. So this is kind of all about the tax on securities income of FIIs. Now, if we move to concept number 35, and concept number 35 is very practical provision, section 211 here, which deals with the non-resident sportsmen or sports associations and entertainers. So, guys, section 211 here, applies where a non-resident sportsman or entertainer who is not a citizen of India and who performs in India or kind of receives income from sports activities in India. So it also covers a guarantee money or any other amount received by non-resident sports associations from Indian governments or Indian organizations, you know, in relation to games or sports played in India, and certain contributions from advertisements or kind of articles related to those events. So in all such cases, the specified income is taxed at a flat rate of 20% on the gross amount, and no deduction is allowed for any expenditure or kind of any allowance. So further here, if we see that, if we see the if the non-resident's total income consists only of section 211 here, so income and the tax has been fully deducted at source at the rate of 20%. So there is no requirement to file a return of income in this case as well. If you see example here, here a non-resident international cricketer, receiving match fees or performance bonuses for games played in India. So so that is taxed at 20% on the gross receipts with no expense deduction, and also that can rely on the return filing relaxation if there is no other Indian income or the TDS is correctly deducted. So this is all about the non-resident sportsmen, sports association, and entertainers. If we move further to concept number 36, so guys, concept 36 here takes us to schedule 4, which lists several incomes of eligible non-residents and foreign companies that are not included in the total income. So the items in schedule 4 covers a wide range of situations. Here, the examples include interest on non-resident external account or NRE account in short form, maintained by eligible non-resident individuals, subject to conditions about residential status and the nature of the account. They also include certain short-term employment income of foreign nationals for brief stays in India, remuneration of staff of foreign embassies and consulates where reciprocity conditions are met, and specified royalties as well, or fees received by non-notified foreign companies, in relation to India's security or other notified projects. So additionally, also interest on deposits in certain offshore banking units, incomes of specified categories of foreign cap companies engaged in approved infrastructure or strategic projects can also be excluded from the total income under this scheme or this schedule. Ag- again, these are all subject to detailed conditions in a corresponding or relevant entries. A practical example is an individual who is a resident outside India under the FEMA and who holds an NRE account with an Indian bank. So in that case, the interest on that NRE balance is not included in the total income in India, so long as the person continues to satisfy the qualifying conditions in the schedule. So guys, this is the concept about eligible non-residents exemptions under schedule 4. Yeah, obviously. Now if we move to concept number 37, so concept 37 is about the International Financial Service Center or IFSC and the exemptions in schedule 6. So guys, Schedule 6 provides that certain income of specified funds and other eligible IFSC entities are not included in the total income or are exempt basically, particularly where they where they kind of relate to transactions on recognized IFSC exchanges or in specified offshore securities. Examples include capital gains from transfer of certain securities on a recognized IFSC stock exchange, where consideration is payable in foreign currency. This is the important point. Consideration should be payable in foreign currency, and the gain on specified fund from eligible foreign securities, to the extent attributable to units held by the non-residents without a permanent establishments in India. The rules here supplement this by laying down how to compute the portion of income attributable to non-resident unit holders and the conditions around IFSC registration and in, instruments and currencies and other related things. So, guys, other exempt items can include income from specified derivatives and offshore derivative instruments dealt with by IFSC banking unit under the IFSC framework. So, guys, like if a specified fund located in an IFSC trades in foreign currency bonds, example, and certain derivatives through an IFSC exchange with settlement in foreign currency, then subject to the attribution rules and the conditions, then the portion of the resulting gains attributable to eligible non-resident unit holders is not included in the total income under Schedule 6. So this is all about the specific exemptions under Schedule 6 for IFSC units. So if we move further, guys, to our concept number 38, let's move to the next slide. Okay, so concept 38 covers the exemption regime for sovereign wealth funds, foreign pension funds, and certain other specified persons, primarily covered under Schedule 5 here. So Schedule 5, allows exclusion from total income of dividends, interest, and long-term capital gains arising from investments by notified sovereign wealth funds and the specified foreign pension funds in the eligible infrastructure companies or business trust, for example, investment infrastructure trust, INVIT, or the NBFCs or the alternative investment funds, subject to strict qualification criteria which is there. So guys, conditions here include that investments must be made within a specified time window, held for a minimum period of 3 years, and in many cases the investing entity must not be engaged in commercial activity and must be wholly owned by the foreign government or structured as a regulated pension fund basically. So guys, there are also proportional rules where the kind of investing entities does not satisfy 100% eligible investment test. In such cases, only the proportion of income corresponding to eligible investments qualifies for exemption here. So if conditions cease to be satisfied in a later year, for example, because of early disposal of the investment or maybe change in business profile, income that was earlier exempt can become taxable in the year of violation of the condition. So practically, this regime is central to long-term, inbound infrastructure investments by sovereign and pension capital funds under the new act. So this is concept number 38. If we move to concept number 39, so concept 39 here looks at a very practical, compliance question where when can a non-resident avoid filing of return of tax return of income in India, right? So, guys, here, I mean, this is a very practical and very important compliance point. Multiple provisions in uh, chapter, 13, including section 190, 209, and 211, provides that where a non-resident's total income consists only of the specified passive incomes covered by those sections, and the due tax has been fully deducted at source at the prescribed rates. In that case, the non-resident is not required to file a return of income in India. These specified income includes maybe certain royalty or FTS or interest or dividends on notified bonds and the GDRs, and the performance and the sports related income of non-resident sportsmen, sports associations, and the entertainers, which we have seen in our above slides. However, this is a narrow relaxation. I would say that, you know the moment the non-resident has any other Indian source income, say capital gain not covered by this section, or say, for example, or say business income attributable to a permanent establishment, the general rule in section 263 requiring a return of income kicks in, subject only to a specific exemptions. you know for residents and some other non-resident situations, Rule 163 separately prescribe conditions such as, high value foreign travel, large electricity consumption, or high TDS or TTCS that can trigger a mandatory return filing, even even when even where the income is below the basic exemption limit. But those are distinct from this non-resident passive income relaxation. So a classic example is a non-resident who only receives dividends from notified GDRs with 10% TDS deduction under Section 209. So such an SSE can generally rely on specific return filing exemptions for that particular year. And guys, this return filing exemptions we have already seen in our few slides which we have discussed earlier in this session as well. Now let's move to our last concept, the concept number 40 of today's discussion. So concept 40 focuses on the operational side, lower and the nil TDS certificates in the context of payments to non-residents. So section 305 of the new act, if we read with the rule 213 and 214 of the income tax rules, so here, this allows taxpayer to apply for certificates authorizing deductions or collection at source at a lower rate or at nil rate as well. So guys, form 128 is there, which is used to apply for certificates in respect of income where the applicant believes that the normal statutory TDS or the TCS rate would lead to excess withholding, taking into account its estimated total income and the tax for that year. And also form 129 under rule 214 basically. So that is specifically designed for situations where a payer seeks determination of the appropriate proportion of sum payable to non-resident that is chargeable to tax in India. So this is especially useful in composite or kind of capital transactions. For example, where only a portion of the sale consideration is taxable in India after considering cost base, or maybe treaty relief or the sourcing rules. So applicants must provide, here detailed information on the nature of the payment, treaty positions, existing liabilities, advance tax, TDS, TCS already suffered, and any earlier certificates obtained in the past. So once the assessing officer issues a certificate, the payer can deduct tax only at the approved rates or on the approved taxable proportion instead of on the entire gross remittance. So we have to deduct the tax accordingly. So if an Indian company is remitting shares sale consideration to non-resident, let's say for example, and only part of the gain is taxable in India under the DTAA, so it can apply in Form 129 to ensure TDS is made only to on that taxable portion only. So guys, these are the 10 concepts which we have discussed today, and I will be uploading more concepts as well in my upcoming videos. I hope you are liking these videos. If yes, please subscribe this channel and comment if you need any, if you have any feedback, or if you have any comments on the further improvements on the slides and on the discussions. I will be very happy to kind of address all those things. Thank you so much.